Hello. Welcome to HDSA's Caregivers Corner webinar series. This is Jane Kogan, and I'm the Manager of Education Advocacy here at HDSA. And today I'm thrilled to introduce Bruce Meyer, who is going to talk about financial management for Huntington's disease. Before I invite Bruce to begin, I'm going to go over how to ask a question as well as how to access this webinar after broadcast. Bruce is going to take questions after his formal presentation. However, you can type in your question at any time. To send your question, go to the control panel that appears on the right-hand side of the screen, type in your question, and hit send. This webinar will be available for viewing approximately 1 week after broadcast on the HDSA national website, www.hdsa.org. To access the presentation, just go to www.hdsa.org/ccorner. You'll not only be able to view a copy of the recording, but you'll also be able to download the presentation. You can also find past presentations there. You could find past Lunch and Learn presentations at www.hdsa.org/LL. And join us the next few months for upcoming webinars. We have webinars once a month. The next webinar will take place on August 20th, and we'll cover driving cessation. And the September webinar will cover long-term care and will be presented on September 18th. And now I'm pleased to turn it over to Bruce Meyer. Bruce has been a practicing attorney and certified public accountant, or CPA, for over 35 years. He's licensed to practice law and accountancy in the state of New York and is the managing member of Meyer & Associates Counselors at Law, PLLC. Bruce's practice concentrates on advising individuals and small businesses in the areas of financial and estate planning, business entity formation, and operation in real estate. Bruce earned the Personal Financial Specialist, PFS designation by the American Institute of Certified Public Accountants. This recognized CPAs with considerable professional experience in financial planning who passed a comprehensive technical exam. For over 20 years, Bruce was an adjunct assistant professor of accounting, taxation, and business at Hofstra University in Hempstead, New York. He was the recipient of the Hofstra University Distinguished Teaching Award. In addition, Mr. Meyer has lectured before many professionals and business organizations on tax, and as well as financial and estate planning. Bruce received his BS in business with a major in accounting from Lehigh University and graduated from Brooklyn Law School and earned an MBA in taxation and accounting from Hofstra. He is a member of numerous professional organizations. And now I'm so thrilled to turn it over to Bruce.
Thank you. Move over here. I can skip the next slide since everything was just said about me. My professional liability insurance carrier has requested that I make the following statement to protect everybody, that this presentation offers general information and is not legal or financial advice. Before acting on anything discussed today, please contact your personal accountant, attorney, or financial advisor to see how best to proceed, given your individual circumstances and situation. And I have to definitely say that no attorney-client or fiduciary relationship is established today. That being said, let's move on and get to the reason we're here. My objective today is really to get to the second point of choosing and working with a financial advisor. But before you do that, you really need to have a basic understanding of what the concepts are of general financial planning so you can talk intelligently to a financial person and that you have the proper ability of choosing that financial advisor. We need to know what investment vehicles may be appropriate for you in this particular situation and what legal vehicles may be appropriate or how the ownership should be worked to best fit your personal needs. Then once we have that understanding, I'm going to urge you to work with a financial individual and how we go about choosing that individual and then eventually working with that individual. We must face certain realities when we're talking about Huntington's disease. And I am not a doctor. I don't play one on TV, and most of you know more about the Huntington's disease than I do. But we do know that it's a brain cognitive issue. And I'm not going to be involved with the medical or the physical aspects of it, but we need to understand the mental aspects of Huntington's disease and realize that the symptoms really affect an individual's ability to make decisions and how those decisions to implement or execute an appropriate financial plan. The inability to concentrate or inability to control impulses can be devastating to somebody who is trying to create a financial plan and to manage his or her own financial affairs. When an individual is diagnosed with HD, I think that is clearly the time to start talking and working with a financial advisor or planner. And we can talk about the term financial advisor, financial planner is exactly the same thing. We want to protect the family's assets, the financial assets of the individual and his or her family. It is extremely important, just as to be honest with that advisor, just as it's important to be honest, obviously, with your doctor. We need that financial advisor to know what is going to happen with a person with HD. And I don't know whether many financial advisors do know about that. So we need to make sure that you talk to that individual and that you make them very well known what may happen now and what's going to happen in the future as things develop. The rest of this discussion is general, broad information because everything that's going to happen as far as the actual determination really depends upon your individual situation. The planning for an individual with HD who is single is clearly different than a person who has HD and is married with children. Another question is going to be the planning of an individual, the age of the individual. Clearly, if you are 30 years old, the planning and in good physical health, the planning is going to be different than an individual who is 60 or 55 years old and has other medical issues. And the fourth item is also pretty obvious, the financial status of the individual. The planning that's going to take place for a wealthy individual as opposed to a person who does not have great wealth is going to be different. So we need to look at all the factors that we have as we're going through the various considerations. My recommendation, and again, just recommendation and thoughts to throw out there, is that we should start looking for investments that take the requirement for you to make decisions out of your hands. Whether you're the caregiver or the individual with Huntington's disease, you're going to have enough to worry about as opposed to saying, well, I'm going to be able to spend hours investing my assets. I don't need somebody outside. I don't need to have an advisor. I don't need to buy an annuity or a managed account. We know that if you're the individual with the HD, you know that your mental abilities are going to diminish. If you're the caregiver, we also know that your time is limited. There's only 24 hours in a day, and you need to remember that 8 of them should be spent sleeping, and the other 16 are going to be spent in many other ways. You don't need the aggravation or responsibility of looking at managing your financial affairs. You want to pick somebody as early as possible and choose some appropriate methods of financial investing. I've mentioned 2 here, and I'm going to discuss them in greater detail: annuities and managed accounts. Annuities. By technical definition, the word annuity means for life. And the original concept of an annuity was that you gave somebody money and that individual paid you a sum for the rest of your lifetime. It could be an individual, It could be an insurance company or whatever. Like all investment vehicles, annuities have morphed and changed and progressed into many, many different types of entities. First of all, the annuities that you're going to be looking at are insurance products. Now, as an insurance product, you will find that there are basically two types of insurance companies. There are stock insurance companies and there are mutual benefit insurance companies. Stock insurance companies are owned by shareholders, and they need to provide a payout to their investors, their stockholders. So they need to make a profit. A mutual insurance company is owned by the policyholders. There are no stockholders. Their profit is really enough just to cover all the expenses and have a reasonable reserve for future expenses and losses and payouts. General statement, and general statements always have exceptions, but general statements is that a mutual insurance company will give you a better deal than a stock insurance company. That being said, never just look around and make sure you check out everything. One thing to remember that insurance companies, well, with annuities, you can buy them almost anywhere. You go to your bank, they're going to try to sell you an annuity. That is because it's an easy product to sell, and annuity companies pay very large commissions to the salesman, much larger than selling stock or bonds. So it's a very easy sale for the financial salesman, and when you go to a bank, you'll find that the financial person is going to push annuities. Look at everything, look at the payouts, look at all the variations, and compare products because they do differ. The variations that exist is, well, first of all, you want to make sure that the product you get involved with is going to pay for at least the lifetime of the annuitant or the individual. Now, I should back up and say there are two parties that we have here that could be the same and could be different. The owner of the policy is the person who buys it and is the legal owner of that individual policy. The annuitant is the person who is receiving or is going to have the payout based upon. The annuitant is going to be, in our case, the individual with HD. They are going to be the annuitant. We want the payout to be based upon at least their lifetime. Now, if you have a married individual, then we want to consider whether we want to pay out over 2 lives, the spouses. It could be, that's called a joint and survivor. Very often you can have a joint and survivor where it's 100%, so the same payout is going to be for both lives. There can be a reduction of the payout upon the first death because there's only one individual. You may not need the same amount of money, so it would be 75% of the original amount, 50% of the original amount. All this is subject to negotiation. The more you're paying out, the less the payments are going to be. It's a simple question of math. They only have a certain amount of money, and if you're basing it upon joint and survivor 100%, there's going to be larger annual payouts. Therefore, the amount that's going to be paid out each year would be less. You say, well, I'm putting in a lot of money into an annuity. What if I get hit by a bus tomorrow? Is that going to end? So we have guaranteed payments that can be provided. The guaranteed payment would be, could be for a certain number of years. You could have a 10-year guarantee or a 20-year guarantee. This would be based upon what you want, how you feel, and the security that you're looking for. People do not like the idea of giving everything upon a single life and then knowing that they could live a normal life for 20, 30 years and they go out and a drunk driver hits them after 2 weeks, that they've lost everything. So a term certain is a very, very popular option. Again, the longer the term certain, the greater the guarantee of the payouts, the less the payouts are going to be. We have variable annuities that we're going to be discussing because there are really three types of annuities that we're going to be looking at. There are immediate annuities, so you put down a certain amount of money right up front, $100,000, $200,000, $20,000, $1 million. The concept is exactly the same. And you have an immediate payout, so that over the life of the annuitant, the insurance company is going to make a payment. How much depends upon various factors. Is it a single life annuity? Is there a term certain? So this would be an immediate payout. A fixed annuity can be a deferred annuity. In other words, you're still working, you're at the early stages of HD, and you still have income, but you know you've got to plan for the future. You purchase a deferred annuity that's going to have a guaranteed increase each year, and the payments will begin at some point in the future. It is deferred until 3, 4, 5 years, or until you decide that you start needing the money. There's a guaranteed growth. There's a guaranteed base. What this does, it takes the risk of investing out of the equation. If you have a guaranteed 5% or 6% rate of increase, you don't need to worry about, is the market going to go up by 2% or 20%. And if you have a guaranteed payment rate of 5%, you know how much money you're going to get. And with this being an insurance product, if the marketplace collapses, assuming we don't have a natural disaster, or if the market goes down by 20 points, your investment still goes up by the guaranteed amount. Variable annuities are a variation on the regular annuity concept. People said, I want to have a risk, not a risk, but I want to have a chance for everything to go up. I know the market's going to go up. I know the insurance companies are going to make money. I want a little bit more than the fixed guarantees. So what they've done is they've created what they call variable annuities. The variable annuities have a guarantee, but they also have an amount that you can invest, and your amount of your base, your investment base, will go up based upon the performance of the stock market or how you've invested your money. This is an interesting concept, so that if the market's going up 20%, your investment base is going to go up also. Generally, you're not going to get the full increase because you're not taking the full risk. As we'll discuss later on, there's always a concept of risk-reward. Generally, your base cannot go down. It is a guaranteed increase of 3, 4, or 5%. It may not be the same guarantee as with a fixed annuity because you're taking a chance of having a higher in risk. So you're putting a percentage, 50, 60, 70% of your annuity base into a stock market portfolio, a bond portfolio, a combination portfolio that is generally managed by the insurance company, but you will have an increase of 80% of what they are receiving. But even if the market goes down, you still have an annual increase. You also want a guaranteed payout. So you want to look at what is the insurance company going to guarantee as far as what percentage I'm going to receive, and what are my investment options going to be. So when you're looking at variable annuities, you really have to try, and you're looking at one company and one variable annuity versus another, we really have to look at these three items to see how they stack up. And it can get very confusing. what are my investment options? What percentage of my investment increase am I going to benefit from? What is my guaranteed annual increase? Win, lose, or draw, what am I going to get? And what is the guaranteed payout? And this is why you need to look at all these and find somebody who can help steer you in the right direction, because it gets rather confusing. And you generally need somebody with quite a bit of experience in this area. A managed account is where you choose, you talk to your financial advisor, and they take your money and you invest in various portfolios. Again, the key to our discussion is to make sure you have somebody else properly managing your money. You do not want to be the person checking the S&P 500 every day. You do not want to look at the Dow Jones Industrials. You do not want to be looking at the stock market pages and find out, did Exxon go up? Did IBM go down? Is Apple still a great stock? Is Samsung a good company to buy? You don't have the time for this. You don't, and as an individual with Huntington's disease is going to discover, they're not going to have the ability to do this later on. We need to choose somebody now who's going to assist in these areas. By having managed accounts, you're going to take your investments and find somebody or find people to manage your portfolio. There are people who specialize in managing stocks, and even that can be managed. You have different people who certain individuals manage technical type stocks, foreign stocks, large growth stocks, and there are individuals who manage bonds, manage commodities. And you look at this and say, I want to create a well-run, a well-diversified portfolio with each manager being an expert. And you then have them running, and you have your financial advisor, your planner, being somewhat of a quarterback. He or she is going to supervise these individual managed portfolios and going to really make sure that the managers are doing their job properly. These managers charge for their services. Nobody works for free. But since they are experts, they should be earning more than enough to cover their costs, which is why we're choosing the good people, and also why you're looking at having a portfolio or a manager, financial manager, financial advisor, reviewing to make sure that these people are beating the indexes. Because we could simply take the money and put it into an S&P 500 index fund and not pay much of a management fee, but we want to get somebody who's managing and controlling our money. So we want to make sure that the managed account is going to cover their costs. Another consideration is the ownership of these assets and use of trusts. We mentioned when we discussed annuities that perhaps the owner does not have to be the annuitant. And the reason we want to consider ownership options is eventual Medicaid planning and estate tax and liability planning. If we keep it out of the individual with HD, we may have more options in the future for medical assistance and for financial assistance. We don't want to do this at the very end as we're going to need the assistance, because as we will discover, you're going to have look-back periods in Medicaid, so you can't just give away your assets today and then have go out tomorrow and apply for Medicaid. There's a 5-year look-back period. So this is why we need to look at all these considerations immediately upon a diagnosis of Huntington's disease and immediate upon realization that we need to do planning. A trust is another way of taking away control. We would want an individual with Huntington's disease to realize that they cannot, in the future, manage their funds. We understand that there are mental situations that we want to avoid as far as impulse changes, lack of concentration that we mentioned, and all the things that, quite frankly, again, you are more aware of than I am. We want to limit the ability to have people spending what they don't have, or trading simply because they had a Apple yesterday at home, they decide they're going to buy everything, sell everything, and buy Apple stock. So we want to create a trust. Well, one of the vehicles that may be a proper vehicle is to create a trust. We need a trustee. So if you are a caregiver, this might be an appropriate vehicle where you are the trustee, and the trustee would appoint a financial advisor to assist in the financial planning and the investment planning of that trust. So just because we have a trust and you are a caregiver as a trustee doesn't mean that they are going to be in charge of making all the investment decisions. But what it is doing is getting it out of the hands of the individual with Huntington's disease. Again, that's the purpose of this. And a properly drawn trust can restrict the ability for the individual to spend money that they don't have, to trade the money, and if it's done with 5 years having been created, it is very useful for Medicaid planning. So these are various factors that we want to consider. My next area is, now that we have a basic idea of general financial planning, we need to have an idea of who we want and what we want to do to go to step 2 and choose that financial advisor planner. The first thing I urge you, again, is to shop around and to make sure that you feel comfortable with that individual, and you have to be honest. That person has to understand the symptoms and effects of Huntington's disease. If they don't, then a very rational person, or a very rational sounding person, may end up calling their broker saying, I want you to sell everything and buy whatever, and destroying all the planning that we're doing. So we need to make sure that the individual who you're advising understands and is aware of the symptoms for Huntington's disease. You have to feel comfortable with that individual. You have to make sure your family members feel comfortable. You have to make sure that if you are the individual with HD, that you have and give the ability to your family members to talk to that individual. Because for privacy reasons, if you do not give power of attorneys, give the right to talk, the broker or the financial advisor, the financial planner, does not legally have the ability to speak to your family. So you want your family to be involved, because in the future, they are going to be the people who are clearly going to be dealing with this financial individual. You want to make sure you understand how they're going to get paid and what experience they have. Everybody gets paid for their services. Is it fee only? Do they charge an hourly rate for their advice? Is it commission only? They are selling you products. And very often, if they sell you a product, they're going to get paid on the commission, on the sale of buying a stock, they get a commission. Selling a stock, they're going to get a commission. Buying an annuity, they're going to get a commission. Buying bonds, they're going to get commissions. So how are they going to get paid? There's also called an asset-based fee, where they don't charge by the hour, they don't charge by the trade, they charge a percentage of your assets. So if you have $100,000 and they charge 1%, they're going to receive an annual fee of $1,000. Hopefully my math is correct. At $1 million being invested, they're going to have $10,000. Right? I hope? Okay. Got my math good. I passed the CPA exam. I can move on. All right. So you want to look at how are they going to be paid, because there's a fear among many individuals that if you're working with a commission-based only, then their incentive is to sell you something and to churn the accounts, where they're going to be buying and selling, because that's how they get paid. Fee only may alleviate some of that concern, where you know that the person is getting paid for their advice. An asset-based combination, you know that they're going to get paid a percentage. And what's nice about this is that they do get paid more the more money that they have in the account. But if they're able to increase your account by 5, 6, 7% a year, and you're paying them more each year, that's not a bad deal, because they have an incentive to make your assets grow. What you have to make sure is that that asset-based fee is reasonable and doesn't exceed what your growth is, and doesn't exceed what your growth would have been if you had done nothing. If you put money into a CD and earn 2%, and you give it to a financial advisor who's charging you 1% and you earn 2.5% with them, you have a net of 1.5%, and you're better off with keeping it in the CD. So we want to look at what their structure is and how they're going to get paid. And these are hard questions to ask, but they are important questions to ask, and you have to feel comfortable with the answers. Another question that is very important is to look at the age and asset requirements of the financial advisors. If the individual that we're dealing with is 45 years old, you may not want a great advisor who is 65, because we are concerned with what's going to happen when we are 55, 65, 70 years old. That advisor may not be around. So we want to look at the age of the individual. You may not want a 20-year-old right out of college who thinks that tech stocks are the greatest things when you're 60 years old either. So you want to look at the age of the advisor and their experience. And we can skip to numbers, we'll go back to the B, but what happens is there support for that advisor if the advisor leaves, retires, or gets hit by a bus. He may be a great individual, but if he's running his own shop and he's the only person who knows about your account, and if he wins lotto and wins $25 billion and he sends you a postcard from Tahiti saying, "I'm gone, good luck," what happens to you and your financial plans? So you want to make sure that the financial advisor has a team that knows about you, has somebody you can talk to if that individual is on vacation, or if that individual becomes ill or whatever. We want to make sure that there is a backup contingency for you. We also have to look at the size of your accounts, because unfortunately many brokerage houses that are very good have a desired minimum investment. I received a phone call from a broker who said that the marketplace was, that they were going after a certain marketplace that he knew that I had individual clients who fit this requirement. And he was very interested in meeting with our clients because he knew that they wanted to go after this marketplace. I said, "That's great, but I know that you work for a large firm. What are you looking for as a minimum investment?" "Oh, we're not that high. We have a minimum investment of at least $500,000. At which point, after I held back a laugh, I said, okay, because my individuals who meet this criteria do not have $500,000 to invest. So you have to be careful as to who you're looking at. So the big advisors want the big accounts because that's where the money is. You do not want to be a too small fish in a too big pond. You want to make sure that you are going to get advice. Your phone calls are going to be returned, that they are going to care about you. And this is very important. You don't want a fly-by-night organization either that nobody's ever heard of and that is under investigation by the SEC, but you want to make sure that the company and the investment advisory firm is solid, is going to be able to handle your size investment. Now, if you do have $500,000 or $1 million to invest, that gives you much greater leverage. People are going to be much more interested in you with a $1 million investment portfolio than they're going to be with you with a $25,000 investment portfolio. Gives you the ability to be a lot more picky and to look at what you're going to be looking for. You want to look at the investment advisor's strategy. Again, you have to be comfortable with that individual. You want to make sure you are dealing with safe investments. We know that we want to beat inflation. We know we want to grow. We don't want to sit back and have the marketplace go up by 10, 15% a year and we only make 5%. But we cannot invest in gold mines. We need safety. We need to be able to match inflation, but we need to keep our investments safe. This is what we have to live on. This is what we have for our family's future. We want growth to keep up with inflation, so we can't put everything into a CD. There has to be some investment in the stock market to keep up. How much? Well, how old are you? If the individual that's investing is 65 years old and we have a 20 or 15-year lifespan ahead of us, we need less inflation increase than if we have a 40-year-old individual that has 40 years to 45 years to keep up with inflation. So this is not that different than the planning for a family without HD, but I think we need to look at the planning for an individual with Huntington's disease to say we need to make sure it's safe but going to grow. Number 6 I put in capital letters because comfort level is so important. You have enough to deal with this disease, with everything else in your life, that you do not need to worry about that financial advisor. You need to feel comfortable with them. You need to feel comfortable with his or her company. You're going to be honest. You're going to be bearing your soul to them, and you're going to be needing to make sure that they are going to be able to handle you, and you are trusting them with your financial future and your financial affairs. And we need to make sure that you are going to be able to deal with them for the long haul. There's a cost-benefit rule. There's always a cost-benefit rule. You can always do things yourself, but the question is whether you're going to be able to do it as well. You could build your own deck to your house. You could build your own house. Would it be better to hire a builder who knows what they're doing? In my case, clearly, we want the deck of the house to stand up. I'm going to hire somebody. With you or an individual, hiring a financial advisor is going to cost money. There's going to be a fee involved, but we know that we hope, we hope that that individual, their expertise, their experience, their ability to know what to invest in, where to put your money, should more than cover their cost, so that they should be earning money for you, not costing you money. And again, I really want to emphasize that you're going to have enough to deal with in taking care of your physical needs so that you don't want to worry about the financial needs. We have to look and put our priorities in here as to what we want, how we want to spend our time. And we want to take care of our family. We want to take care of our patients. We want to work with our individuals. Let the financial issues be handled by professionals who are going to be able to take care of those needs. With that, I'm going to leave it for questions and hopefully for answers. And if you have any questions on what I have discussed, please feel free to contact me at bmeyer@meyeresk.com, and our website and our phone number is 631-434-7633. I am available and would be happy to hear from anybody at any time. Thank you.
Thank you so much, Bruce. Now we can take questions. As a reminder to type in your question, just type it in and hit send, and then Bruce will take them as he receives them.
Good. See any? Okay.
All right, we have a few questions.
Okay.
So
I put my glasses on. Does it make sense to divorce the HD individual as a means of protecting assets? Unfortunately, it may be a consideration. It's not a pleasant consideration, but it gets into the Medicaid planning that we need to worry about. By taking the assets out, you're going to protect against future creditors and against from Medicaid planning. It is something that is a very hard decision to make. You have to make sure that it is not a fraudulent divorce, which sounds kind of strange, but if you are divorcing and living together and cohabitating, the creditors may be able to go against you and say that this is not a real valid divorce. I am not a matrimonial attorney. I do not touch divorce, but this might be something that would be useful based upon the state that you're living in. How does long-term care insurance fit in the equation? Well, the problem I see is, unfortunately, once you have HD, I think it's probably a little late to get the long-term care insurance. It'd be very difficult and or very expensive. It is another reason why people should get it, but we, as a financial advisor, we generally advise clients to start getting long-term care insurance at about age 50, age 55. At that point, most people with Huntington's disease already have the disease. So I would say, and I believe this is one of the discussions that's going to be held in, I believe, in September. If my memory serves me well, September 18th, there's going to be discussion of long-term care insurance, I believe. No? Long-term care. I'm sorry. So long-term care insurance is not discussed. I apologize for bad memory. So I think, unfortunately, I would say that by the time you have it, it's too late to look at. Is there a website to find help, find professionals in my state? Well, I don't know the answer to that. Unfortunately, I don't know what state, and I do not know if you're looking for a financial advisor. I do not know really if there is one. I unfortunately cannot answer that question, finding a financial advisor. I have a joint checking and savings account with my husband who has HD. I was told this could transfer between husband and wife. He also has an IRA with his former earnings. An IRA, depending upon the age, if you can transfer between husband and wife pretty freely to avoid Medicaid, so this is not horrendous. I would question the having of joint checking and savings account as the person starts losing a little bit of self-control, because if they have a joint checking and savings account, they can write a check out for the entire amount. So it is not for half, it is for the entire amount. So if there is an individual, your husband does have HD, you may want to consider looking at taking it out of their name and putting it in your name. If you want to leave that person with what I call self-respect and feeling that they do have some money, open up a separate account or a small account in their name where they have ability, maybe perhaps joint, but leaving the majority of assets in their in your name. As far as the IRA, they are the owner. They are realistically the only people who can take it out. Depending upon their age, if they've started taking it, it is an exempt asset for bankruptcy. So and IRAs are exempt from bankruptcy proceedings. So there isn't much planning that can be done at this point. Any savings or investment ideas for young people, early 30s, without much in terms of savings or assets? Where do you start? Good luck. I don't mean to be short or whatever, but with that, but it is not easy. And you have to start just being regimented and start putting money aside, 10, 20, or 10, I would say $10, $20, but putting money aside at early age is extremely important because of the element of compounding and growing in the marketplace today. People in their early 30s clearly should be investing in growth assets where not in long-term bonds, not in CDs. You need inflation protection. I would start looking at a mutual fund, even if you don't want to start analyzing it, something such as an S&P 500, a Vanguard or T. Rowe Price S&P 500 fund will give you the growth rate that you're going to need. What if you have no money to invest? I am 55, have HD, and on a disability. I don't know what to say, and I apologize, but it's going to be it's not easy, and that is one of reality. There is not much I can advise. If you have no money to invest, choosing a financial planner is not going to be really that much I can advise with, and I apologize for that. I wish I did have the magic answer. Trust me. Is it wise to have parents put their inheritance money into a trust that can't be touched until after the HD person has died? Yes. Again, one of those reality questions that we must face, reality issues. I would strongly urge family members to create a trust, if the parents, to put money into trust for the family or for the individual who has HD. You make it what they call a spendthrift trust, so the HD individual does not have the ability of controlling the money, but would have the ability of having access to it. It could also be used as what we call a special needs trust, where the trustee has the ability of spending the money for items that are not being paid for by the state. If nothing is being paid for by the state, then the money would be used for the benefit of the HD individual. If that person has state benefits, federal benefits such as Medicaid, then the trust can be used for that individual and not in their estate, not being attacked. If there's a family involved with the HD, if there's a spouse, if there are children, we can see that it's going to help. It can be used also to help the family members. This would be a trust that is created by a parent, is not what they call self-settled trust, and it is much better as far as rules for Medicaid. My experience is, the question is, my experience is that the typical HD individual has made poor decisions and lost most assets by the time he or she accepts that they have HD. This leaves the family with only Social Security disability income and no medical insurance for family members. Typically, family members are supplementing their care in various ways by this time. Any advice for this more typical case? Well, I think the reason I'm here is to urge the family members to face reality. Once you know that an individual has HD, you have to start taking those decisions away from the individual with Huntington's disease. You cannot say, well, it's going to get better. You cannot say, I don't want to hurt them. You cannot hurt yourself. And you cannot hurt them later on. We need to face reality. It is a very painful reality. And it is frustrating. It is hurtful. And I don't know of any way to sugarcoat it. But we need to make ourselves aware that we have to protect ourselves and protect our family members, and we have to protect the individual with HD. There isn't much I can recommend after the damage is done. If there's no assets, there's nothing I can really say at that point. Buying an annuity, if there's no assets to buy the annuity with, or setting up a managed fund is not going to help. So this is why we need early working on this. And I appreciate the question, but I don't know how to really answer it in any other way. What is your comment concerning an elder law attorney providing advice about Medicare benefits, incapacity planning, and estate planning and administration? Well, it depends upon the elder law attorney's background. I mean, generally, elder law attorneys should have experience in Medicare benefits, incapacity planning, and estate planning and administration. If the only background they have is to create Medicaid trusts, you need somebody a little bit more broad than that. You don't want someone who just does estate planning. You want to make sure they understand all the ramifications, because this is a particular situation. And we need to make sure you have someone who understands what is going on and what is going to go on. So we don't need just an estate planning attorney, and we don't need just an elder law attorney who's Medicaid centered. We need to find somebody who has experience. And choosing an elder law attorney, choosing an estate planning attorney is an extremely important decision also. And I know that last month was a discussion of of elder law planning and estate planning, and personally I cannot stress enough the importance of having estate planning documents, making sure an individual has a health care proxy, making sure even more importantly they have somebody else to make those decisions. A will is important, clearly, but making sure an individual with HD has a properly executed, well thought out power of attorney that doesn't end upon disability is extremely important, as important as anything I said today. Disability funds, if they were out of work for more than 5 years before they were declared disabled. And unfortunately, I do not have an answer. I do not know that. I think we'd have to contact a Social Security disability attorney. There are people who specialize in that, and I apologize, but I do not have that particular answer. That seems to be the last question. If there are any others, if you have one later on, you've got my email address. I will be happy to try to answer anything you do. And I thank you.
And we have a few more minutes if anyone has any last-minute questions.
Okay. I will be here, so thank you. And I will be here. We've got, thank you. Thank you for participating. Thank you for my help. And it's been a pleasure and an honor to be here. And thank you. And good luck.
Thanks, everyone, and be sure to join us again next time. And I will be sending out an evaluation of this webinar, so please be sure to fill it out when you receive it. Thank you so much.